All right, guys, welcome back to a session. I want to go ahead and touch on options trading. We've got a lot of new people that are just interested in options trading. And of course, it is very overwhelming when you first start out. It's not something that is just like easy to go to and understand it fully. I mean, it looks overcomplicated, but it's actually very, very simple. It's not a very complicated way of trading. But it is a two-part, it's kind of like a two-part trading system. It's kind of like it's not like you just buy the stock and then you're set and then you're trying to sell it for whatever. So it literally takes two parts to trade options. Um, there's a lot of slow things going on with OTC right now. So a lot of people are trying to chase where some money's at. Big boards are really hot right now. Options trading only trades on big board stocks. It is not something that's a part of OTC or any other market out there. It's literally just for big board stocks. And what I mean by big board stocks is Nasdaq, NYSE, Amex, different exchanges out there that represent more advanced companies, even small caps, small caps, medium caps, and large caps. But we mostly trade options on the large caps, such as Tesla, Beyond Meat, Home Depot. There's a lot of different stocks out there. Amazon, those are massive, large caps, and there is options available for smaller caps, but it becomes a lot less liquidity. Which I mean by liquidity is it's less volume. There's not as much people interested in buying options for those particular securities. So when it comes to playing options, you want to be able to understand the chart that you're trying to play in general. Okay, let's just give an example here with Tesla. Okay, I'm looking at Tesla chart. Tesla's chart pulled a very bullish trend up there towards the last on Friday, and I'm interested in trading some options on Tesla. Now, instead of buying the stock of Tesla, for $899 a share, you're literally sinking in $900 to buy one share. I mean, how exciting is that for someone that has a small account? Not necessarily very exciting. Um, Obviously, stocks like this that have a tons of volatility, these are huge volume for big board stocks like large caps like Tesla. But it is available out there, and I'm going to show you on a small account. This is a small account I grew started in January. It was like 164 bucks, and I've got it at 1,289 now. So it shows you that you can make a tiny little account grow to make actually some decent money with it. Obviously, as you grow, you're going to keep compounding it over and over again. So what this is Robinhood. It's a very simple platform to use that just trades big board stocks and also options. When you sign up for a brokerage account with Robinhood, I think there's some things that you have to sign in order to make sure that you're eligible for their options trading and so on. And it is a margin account. There is no cash account associated to Robinhood, so you do get the PDT rule, where it's 3-day trades every 5 period or whatever. Um, and with E-Trade and other brokers, actually, if you do a cash account, you can just trade your cash that's settled every day. But I'll cover that a little bit later in the lesson. But in this session, I want to go ahead and touch on how to trade that security. So in a sense, you're looking at Tesla here. Okay, it's a bullish trend at 900 bucks, and you're looking at the chart and you're like, okay, well, I think it's got upward potential to see, maybe 920, 915 in the near future. It depends how long you want to play the stock for. Now, us as day traders, we like to play very short-term play. We're looking at a way of just scalping the play just for a 50 half a cent move, maybe 1% or 2% move on the actual stock, but it's amplified when you play the options on that security. So in this sense here, I'm looking at Tesla and I'm thinking, okay, well, I think it's got potential to break this 913 here on the chart. And charts have a big rule of understanding the direction that you're trying to play the stock. Okay, if you guys don't know charts, I'll do a little basics on understanding resistance and supports and trend lines and so on to understand how to play the chart, for say. But in this sense, I'm thinking bullish on Tesla right here. Okay, so let's go ahead and let's find an option for Tesla. So in your search bar with the Robinhood account here, you're going to pull up Tesla. And you're looking down here, and there's let's say there you can actually buy the stock, and of course, one stock costs you $8.99, but I don't want to do that. So I'm going to go down here, and this little bar down here shows me trade Tesla options. So I'm going to hit the options chain here, and of course, you're going to see all these numbers. Don't let these numbers overwhelm you. There's nothing to be scared about the numbers, but in this sense, I want to be able to trade it. Okay, so in this sense, they've got these are what you call your strike price. Okay, and think of this as a bet. Okay, Tesla, you're betting that Tesla is going to go in the upwards direction. It could go up in the $10, $20, $30 move in your direction, in your favor, that you're saying, I want to go bullish on Tesla. Well, the current price of Tesla right now is $899. I want to be close to the money. I don't want to be the guy that's going to be trying to find an option chain way up here at $1,888. And yeah, it's 34 cents. It's cheap, but it's low interest. There's not a ton of volume for these for these things. And you got to realize these options have an expiration date. Okay, it's not like I can buy an option and hold it for as however long I want to. Okay, and this bet, as you will, playing the option, is literally a bet that Tesla can reach an upwards trend. Okay, it doesn't necessarily have to reach $1,880, but it's going to reach an upwards trend in my favor, and I'm only going to play it for one day. Okay, and let's just say this expiration is a weekly. Okay, this expires on February 28th, and we look down here at the calendar. That's next Friday. Okay, and these weeklies expire every week. Okay, every week new options appear on Thursday, and then they expire the following week on a Friday. So 8 days for each new set of options that exists. So obviously, when we see 34 cents and so on, that's so far out of the money. But what I mean by out of the money is I'm betting that Tesla is, this is so far away from the current Tesla price of $900. It's literally 100% move compared to what we're dealing with as far as here at the top, $1,800. So I want to play Tesla closer to the money. Okay, not necessarily on top of it here. Obviously, it gets a little more expensive for sure. But I want to play something in the realm of potential to go up in that specific thing. And sometimes it's pretty rare. Well, I shouldn't say it's rare, but I try not to do something with such a close expiration date. I like to have a little flexibility, because you got to realize when people are looking at options or traders are looking at options, each one of these contracts or options expires, and that actually takes the value down. The closer that your time comes to the option expiration date, the less value each one of these contracts start going down. They start going down on value, not necessarily because the stock is falling. The stock could be climbing, but the options will be decreasing value because the interest on that option contract is diminishing, because in everybody's mind is, well, Tesla has no chance of reaching, obviously $1,500, $1,800 in, next Friday. People don't think, oh, it's going to have the potential to go that next Friday. So that is a big factor where it plays against you when you're choosing out. Obviously, if you're going to choose something like, let's say, September 18th, maybe I can think of Tesla reaching $1,800 by September 18th of this year. Obviously, it's a lot more expensive, but there's a more higher probability that it's going to go up. So that option, that for that same exact call option, you see it's a difference from $37 or from 37 cents to $37. Huge difference, okay? And us as day traders want to capitalize on the movement these are going to make. So just looking at the chart right now, I'm going to be like, okay, well, I'll look for an option call that looks great. And options don't trade in pre-market or after hours. Okay, so any activity that Tesla or a stock is going to move in pre-market, which is before the opening bell, let's say the stock goes up before the opening bell or goes down before the opening bell, your option is not going to react to that action because they're not tradable yet until 9:30 a.m. Eastern Standard Time. So you want to be able to it's risky holding some overnight on options, just in general, unless it's got a very far out expiration date. But you want to be able to capitalize on that move, okay? And as me as a day trader on these options, I'm literally playing them in the same day. I'm buying them today and selling them today. I'm not buying them and holding them for a couple weeks or near expiration. But it's pretty crazy. You don't, just because you're looking at the option chain and you're like, well, it expires, you know, February 28th. So I've got to literally hold my options till February 28th before I can get out of them. No, you do not. You do not have to hold the option for the full period of time. You can literally flip them. Okay. And when I pull up an option, let's just say I'm gonna pull $1,000 contract here. I'm saying that Tesla has potential to reach $1,000 by next Friday. Okay, they're $11.10 a contract. Okay, and here is the bid. The bid is at $11 and the ask is $11.20. Okay, that's, you've got your own level two within its own thing, and each contract represents 100 shares of Tesla. Okay, and we just looked at, it's going to cost us $900 to buy one share of Tesla. Well, I can buy 100 shares in one options contract with $1,100. Okay, so just because this says $11, you got to times that 100. Okay, so I'm going to hit plus. I'm going to continue. I'm going to say, okay, I'm going to buy it at 11.10, somewhere in the middle there. I'm going to review it. Let's say buy one contract, and you see your cost is going to be $1,110. Okay, so just because it shows $11, it's obviously, you know, it's not just $11 because you can't just buy one. Obviously, if you go down here, go back here, X this one off. You know, you look at $30, that's $3,000, that's $3,500, $3,700, $4,000 to buy one contract. Okay, when it's so far close in the money. But the idea of making good money on an upwards trend is being as close to that $8.99 as you possibly can, that you can possibly afford. Okay, don't just go through the option chain and be like, well, I can't afford any of these, but I can afford at 90 cents, you know, because 90 cents is only $90. You know, I can go through and like, oh, it's only $90 for one contract. Well, what is the probability of Tesla reaching $1,560 by Friday? Well, it's probably slim to none. Okay. And you're going to be looking at this and you're like, well, there's only 160 contracts bought. Okay. Only 202 people have been interested in that contract. And there's only been 168 contracts sold. So the volume is very low. Okay. Look at the bid, 60 cents for the bid and $1.20 on the ask. Okay. That's literally 100% difference. Okay. What if you wanted to slap the ask, which is buying what is being offered on the ask for one share? Let's say I bought one share for 120 bucks. And then decided to get out of it because the time decay is going against me, then I have to sell to the bid for $60 loss, 100% loss, one contract. So that's the losing way of playing options, and you do not want to be playing this in a losing manner. They're very risky, but they actually hold. You know, these things can move 100% plus in just a couple minutes. Okay, they move a lot like OTC. That's why we like to play them. But they do cost a little bit more. But in the sense, like I said, I started with this account with just 168 bucks, 164 bucks in January, and it's grown its way all the way up here to the top. You know, I started with cheaper options, and there is cheaper alternatives out there. Okay, let's take a look at AMD. AMD had a massive pullback on yesterday, right here. Had a massive pullback. And what I do here is I look at a 2-minute time frame. Okay, these are every single candle represents 2 minutes of time in the chart. Okay, so I like to do 2 minutes when I'm day trading because I can see the movement every 2 minutes very quickly. It's responsive. Obviously, if I pull things out to like 10 minutes, then it's going to be a lot less candles, and every move represents 10 minutes. But with options and being quick on scalping plays with options is every candle makes that stock go up or down, very, up or down pretty dramatically. Not necessarily everyone, but it just depends how close to the call price, like the betting price that you're betting on the stock to go, and the expiration date. It just depends on that because they create more volatility. So the closer you are to expiration and the closer you are to the actual price of the stock, they move up. They have the most volume for that contract. So with this say, I'm looking at AMD, okay? It had a massive dip right at close. And automatically, I'm looking here at this chart here, and I'm seeing this is support, this is support. Maybe this chart will kind of ting its way down here, and they'll bounce off of that 53, okay? So in that sense, I'm going to wait for a potential options contract for the upside. Okay. And this is literally like a 2-minute, triple bottom on a 2-minute time frame, not necessarily solid, solid support, just being on a 2-minute time frame. But with this in, it gives me an idea that I want to wait for this reversal to happen. So I want to start waiting for some green candles to start forming before I start betting on the upside that this is what's going to happen. So I'm sitting down here at the bottom, my contract. I'm looking, okay, instead of buying, long on the stock, which would cost me $53 per share, it would get expensive. So I'm going to be looking for some option contracts for that. So AMD is at $53, and these options contracts are pretty cheap. Okay, I'm gonna pull up here, and what do you know? $53, and you're looking at contracts that are only $1.44. Tesla's expensive. Okay, a lot of us big guys like to plan because there's, it makes big money really quickly, but it takes a lot more money to play those. So in this sense, one contract here at 53.50 would be only 144 bucks. Okay, and this is for the call. This is the call, which means for the upside. If it's a put, it means it's for the downside. And as the stock has fallen down a lot, these puts are up. You see this 360% move, 379% move, 400, and even further sometimes. So that's huge moves, okay, guys? And when you can capitalize on these moves on perfect opportunities, this puts OTC profits to shame sometimes on different picks, okay? So with this sense, I like to pick round numbers, okay? With this at $53, I would rather pick a 55 call or no further than a 60 call, okay? When you start picking 58.50s and 57.50s and 57s, they're not round numbers to traders, okay? And it's kind of funny how traders pick round numbers as the most volatile options play. So here I'm gonna pick a 60, and you see there's 600 open interest. If I pick a 59.50, there's only 320 interest. So there's less open interest on this contract versus the 60. Okay, and yes, it's cheaper, and that's the funny part. Yes, it's cheaper. It's closer to the money. Let's go back to the call. It's cheaper to the money, but it's kind of funny how people react to those round numbers per se. So in a sense, I'm gonna look at $55 calls, and you see how cheap they are. They're only 82 cents. The bid is 81 cents and the ask is 82 cents. Okay, literally 1 cent apart. In my opinion, for you guys to start out, AMD is literally probably the easiest one to play because the bid and ask is so close together. Okay, 82 cents versus 81 cents. Like, the chance of losing is so slim when your bid and ask is very tight. And obviously, you're not going to buy a call until you have confirmed with yourself that this chart is in an upwards trend according to your call option. And you're giving it time to say, well, I think AMD can hit $55 by next Friday, no later, but I'm only going to day trade it. So I'm really want to trade it in the sense that I'm betting the stock goes up in the upwards direction. I'm grabbing a bottom. Let's just say this is right where I'm grabbing right here. I start seeing my green candles forming here. It's riding on support. It's bouncing off support. So I'm probably going to start grabbing my entry on a options call, and I could sell out for a potential up here. This is what, 53.15 to 53.50 roughly. That's not much of a scalp. I might make a few dollars on that move. It's not going to be dramatic, but like I said, you're going to go back to that options contract, and you're going to be betting, okay, well, I'm just going to pick a $55 strike. There's 2,000 in open interest, lots of volume, 12,000 contracts have been sold. It's 82 cents. I'm going to go ahead and hit the plus sign, hit order. Let's say I'm going to grab 10 contracts. 10 contracts would cost me $820, which replicates 1,000 shares of AMD at $55 a share. I mean, how great is that? That's pretty crazy. If you were to buy 1,000 shares of AMD, it would cost you what, 53 grand versus $820 to buy you 1,000 shares of AMD at only $820. So that's why it's so amplified with options. Options were actually created to be a hedging for big counts hedging their portfolios without selling their stock. Let's say they had some long positions in stock. They were using options to hedge it when they were down on the stock versus up or down, depending. but now that options have kind of relayed itself as there's traders that make their bread and butter strictly just off options, and there's a lot of big money in it. So in this sense, you want to be, you want to keep this in mind, guys. I'll go ahead and put it on a white screen here for you. Firstly, you want to make sure that your call is close to the current price that you can afford. And number two, you also want to make sure that expiration gives you enough time. And it's risky to have only one week expiration. It's actually better to have more like 3 weeks or 4 weeks out minimum as expiration. So it gives you a little bit of time for the stock to react to the move that you're calling for. So in a sense, your number two, you want to make sure you give yourself 2 to 4 weeks, preferably, on expiration for the call. Number three, you want to make sure that you understand your chart that it's representing. Understand the stock's potential move. And that's how you're literally betting on the potential of the stock. So in that sense, I might be, the stock's doing this number right here, and I want to buy that contract. Well, I have a clear idea that this trend is upwards direction. So I'm buying a call here. Everything speaks to me on the chart that it's upwards. I want to make sure I buy that call that's maybe out of the money, but, still within reason that I'm betting it to hit up here. It doesn't have to be a specific price, okay? So in this sense here, go back here. In this sense here, it does not have to be, just because you're betting on $55 does not mean you have to wait for the stock to actually get to $55 to sell your contract. Okay, that's just literally betting the upwards directions. Okay, so just think of these numbers as up. Okay, just think of these numbers as up arrows. Don't even think of them as dollar signs. So when I look at these numbers, all I'm thinking of is they're up arrows, and I'm buying contracts that's telling me that it's going up. Obviously, when I'm buying puts, I'm going to be like, okay, I'm going to be looking at puts, and as the farther out of the money, let's say it's at $53, the puts is kind of shorting the stock, so I'm betting the stock to go down. So in this sense, I'm betting on the stock to reach, whatever price. If it's a $53, if it's at $53, I'd probably bet on maybe 50 here. So I'm betting the stock to go down. All these things are down arrows to me. They're not prices I'm trying to reflect on the stock to actually hit it on the 28th. Now, obviously, if you hold, what I mean by in the money too, let's just say you're in the money on a call. You betted that the stock would, let's just say it rebounded right here. Let's just say it did a nice rebound here, and you betted on 53.50 calls. And you're in the money. Okay, what I mean by in the money is you betted on that stock to go to 53.50 is what you bought a 53.50 call, and you betted that it would go to 53.50 by Friday. And what do you know? The stock reverses. It's looking good, and you're buying it for the upwards direction of the trend in the beginning. It comes to 53.50 and it keeps on going. Okay. Just because it goes to 53.50, your contracts will not execute. Okay, you're good. You still have them. They don't expire till the 28th. The higher up that stock keeps going past your call strike, the more value they just keep accumulating. Okay, so there's nothing wrong with buying it out of the money for say, if it goes on past your point where you called it. Okay, so 53.50. If the stock is going up and goes past 53.50. Your call options keep going up, 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 up. Obviously, if I can even buy in the money calls, you've got more security. And as you see, they're in the money. Let's say the stock is at $53, but I'm gonna go ahead and buy a $40 contract. It's gonna cost me $13 because I'm so far in the money. But the volume is so low. It's not necessary to buy something that that far in the money. I mean, not many people are interested in it. There's no potential for it to literally really move up more in price, because you want to capitalize on this price increasing on the contracts. You're playing it for the increase on the contracts. Um, so that's kind of how it is on Robinhood. It's very simple. It's very user friendly. I'm betting on the stock to go up. I'm buying a contract that shows me in the upwards direction. It's cheap. It's 99 cents, which represents 100 shares. It costs me $99 to buy 100 shares. Obviously, the more contracts you go in, the more expensive it's going to be. But as you guys are starting out, make sure you're buying only one contract at a time. Okay, buy one contract. AMD is cheap. You want to make sure AMD is heading in the correct direction. You understand the chart on it. Like I said, it's made a massive pullback, so I'm still waiting on this one to actually confirm a bottom yet before I'm going to start buying some calls for the upwards direction. This thing literally was at $59 not long ago. So I feel like it's going to come up. It's just a matter of time for reverse, and it's going to be calls. So with that sense, looking for that, make sure you're close to the money. Make sure you've got enough time to expiration date. Obviously, the further out you choose the expiration date, the more expensive these calls get. They actually got some new ones here. They're not really any money involved in those. Okay, there we go. So March 13th, that gives me literally 3 weeks. Yeah, 1, 2, 3 weeks to expire. So you see these are $2.70 a call. So $227 for a contract to expire. If it, let's just say you did hold it to expiration date. Let's just say you held it to March 13th and the stock is at $60, but you still are holding your $55 call. If you do not sell it before the end of day on March 13th, your order gets executed. Okay. What I mean by your option gets executed is your broker will sell the contract and make you buy 100 shares per every contract of that stock that it represents. Okay. So you're going to literally be spending $5,500 to buy, this what it is. It's guaranteeing you a price of $5,500 for 100 contracts of AMD. And obviously it's at $60. So that's a deal. You still got that profit on it. But if you don't have enough money to cover it, it's just going to sell the option or expire if you don't take care of it. So that's kind of how they're played, and I play them differently. I don't even bother with the Greeks. Obviously, people are like, well, you got to know your gamma, theta, vega, and delta. I don't give a shit about the Greeks. So Greeks don't bother me at all. All I'm literally doing is buying a call or a bet. In my mind, it's a bet where I'm betting the stock goes up. I make money on the value that each option contract occurs during the move of the upward trend, and then I sell it. Okay. I'm literally looking for a move. I would just treat an option exactly how I would treat a scalping day trade. Okay. So I'm buying a bottom and selling a top, buying a bottom and selling a top, making that move. And you can accumulate thousands of dollars depending how big you go into these, but make sure that you're buying one contract until you get, adjusted to it, used to it, understand it. And don't hesitate to come in the chat room and ask me about it. For you, those on E-Trade, I actually do a lot of my trading on E-Trade. You're going to go to your options chain and pull it up on your E-Trade. And you're going to just put all here on strike so I can see all the contracts available for Apple in this sense. And I want to just calls only. Okay. I'm thinking upside. If I think puts, then it's going to be downside, but I'm thinking calls only. So upside. The stock right now is at $313 a contract, or $313 a share. So I'm betting on the stock to go up. Let's just say the chart shows me upwards potential. I buy it on a good dip. Let's just say I want to look at contracts that are near 300. Yeah, I'll do that. I'll do the 313 there. So I'm going to pull down 313. And these are contracts that are going to be near the 313 right down here. So 313, all these are out of the money. Okay, these are in the money. So these are out of the money. They're going to be cheaper. So I'm going to pick a $320 call. It shows that the current bid is 185 and the ask is this. So I'm going to go ahead and hit the details on this. We'll go ahead and buy down here. And right now you see that our stock is at $312 a share. I'm going to go ahead and get an expiration date of, give myself a little time here. Well, I don't know. There's a big difference on price there. I think I can just play it for a day trade on 185. So 185 bid, 190 ask. And I put a limit, make sure my price is a limit, not a market. If you do market price, buy or sell, you're literally going to get the worst price ever for your buy or your sell. So make sure it's good for day, buy open for buying, and I'm doing I'm betting that the stock Apple goes to $320. It's a call, not a put. I'm doing one contract at $190 on the ask. Let's just say I could do, let's say I'd rather bid set, and let's see if I can get a feel first. So it's going to cost me $185.52 because commission gets charged on E-Trade to place option contracts. On Robinhood, it's free. So that's why I say it's one of the better ones too that are user friendly. You can kind of get used to understanding how to trade and so on. So with this said, I literally am buying it for the upside potential of this call. I look at it, it's 185 bucks and so on. So it's not much different. Obviously, when you want to sell it, you want to make sure you sell close. And then you're going to be selling it for the bid, ask price, or whatever, and try to sell it for, and you're going to be selling it. Let's just say it moved up, and you're going to be selling it at 225. Then each contract is going to be 225 bucks a contract. So you made a move from 185 to $225 contract. Obviously, if you had 10 contracts, you're just making the move on that move times 10 or so on. So make sure it's good for day, limit order, sell it open. No, I want to sell it close. I'll sell close, not sell open. So buy open, sell close. Okay. When it comes to selling the particular play on that call. So in this sense, I want to get you guys understanding support and resistance of how to kind of understand your charts. With this said, Tesla represents a lot of good trends and a lot of good support and resistance. When you're looking at this, I'm going to go ahead and pull it up another screen here. So in this sense, you're looking at this chart. I'm going to pull a 5-day. I think 3 minutes all they got on here, but I'll pull a 5-day, 3 minute. It's fine by me. So I'm looking at this trend on Tesla. It's made some massive moves. Okay, it's been crazy. So in this sense, the chart looks bullish, and it came down massively and then tested support. Now, what I mean by support is you guys got to understand that your cheapest call options are going to be when a stock pulls back dramatically. And that's when you want to buy the option call cheap. If you can buy it cheap, then that's your potential for upside gain. Obviously, if you buy a call option at the top of a chart or the top of an uptrend, then you're going to be actually buying it way too expensive, and then the stock comes down, and then you're going to be selling it for a loss. Okay, so make sure, just like anything with trading, OTC doesn't matter, that you're buying a good support area for an upwards move. So in that sense, I'm waiting on the stock to build its foundation, and every past resistance becomes a past support. So in this sense, you look at Tesla here. This is support. This is support. It's confirmed uptrend. It's confirmed uptrend. This is support. It's confirmed uptrend. And obviously, you want to be selling at the top, and you can get your profits up there. You want to make sure this is your upside. But you're going to be waiting for that support area, and us guys will sit literally on the bid, waiting on options calls, because they become their cheapest point on a pullback trend for a stock. You don't want to buy the top, you want to buy the bottom. So it goes with anything. But anyway, also I want to touch on SPY, okay, the S&P 500. This stock literally is an ETF. It has 500 of the most top world, Fortune 500 companies in just this one stock alone. It's an ETF. This stock literally dictates the move of the markets, okay? So if this stock goes up, you're going to be seeing Tesla go up. You're going to be seeing space go up. You're going to be seeing Amazon go up. But if Tesla, or let's just say this stock goes down, then you're going to be seeing Amazon go down. You're going to be seeing a a lot of different factors coming down. So this is very important to have this stock on your screen no matter what. Yes, you can play options on it, and actually options are pretty cheap on SPY. But I don't necessarily play options on it because the moves on this stock are very minute. Okay, they move like 20 cents in 20 minutes. It's not a big mover because it represents a lot of stock. So when Apple's going down, Apple actually hurts this stock. Because it literally represents Apple, it represents Google, Microsoft, all these other big companies in this one stock in general. So when a sector is hurting, this is what they call the markets. This is literally the market dictator, so to speak. It's speculating on the market move by understanding SPY. You got to watch SPY consistently and understand that if SPY is going up, then most of the other stocks are not going to be hurting. They're going to be kind of going up in that general. If it's SPY is going down, then you're going to be, SPY is going to be hurting quite a bit. And SPY made a pretty big crash on Thursday and decent red on Friday. Okay, 1% down is huge for SPY. And it was at what, $334, fell all the way down to 332. So that's a huge drop. So the markets were rough. So watching that consistently, understanding that just because you think Tesla's going to go up, obviously when SPY fell, this is what it made Tesla do. It made Tesla drop from $903 down to $883. So when you're watching SPY do its drop, just like this, Tesla was doing its drop too. And then when SPY actually picked up, Tesla picked up as well. And it kind of reversed a little bit here when SPY pulled back on this little bit of a downtrend here and then reversed again. And then Tesla went right back up with it. So it doesn't necessarily follow the trend to a T, but it's a good way of speculating upside and downside per se. So anyway, yeah, this is what's really hurt Tesla a lot was on that other massive dump with the markets doing that whole correction as well. But anyway, guys, that's pretty much the basics. As long as you guys can understand how to read a chart, understand support and resistance, it makes it very helpful to understand how to buy the options. If you guys got any questions, don't hesitate to message me. You can message me in the chat room. But anyway, if you got any questions for that, I know it can be complicated, but start with one contract. Don't overthink it. You want to be close to the money, as far as close to the current stock prices you can afford, and think that you're judging the stock. So you're literally watching the stock while you're trading your options in the background. Okay, so we don't want to be that guy who's has no idea what he's. I'm trying to minimize this here. You literally want to watch your options contract do its move, and the level 2 on the option. Specifically right here, I want to be watching the bid and the ask continually to understand, well, when AMD is going up here, if AMD is coming down, my bid and my ask are going to go down, and so is the value of my options contract. If green candles start forming here, the bid and the ask is going to go up on my AMD. It doesn't matter about the bid and ask on AMD as the stock. It just matters on the bid and ask on my options contract, period. So this is literally amplified. This is AMD amplified times 100. Okay, so it's a big move. AMD falls 7%. What were the puts? The puts fell over 100%. Okay, so that gives you an idea. With AMD dropping 7% on Friday, the puts made 136%, 140, 150% on that move. It's crazy. So just because this stock moves 7% or 5% or 3%, you're still making 100% plus on your options contract. So you stuck $800 in there, well, you're going to be getting $800 plus on your profit. Obviously, some of these guys are sticking $10 and $15 and $20,000 in some of these contracts because the volume can support it. There's a lot of people with a lot of contracts that are buying and selling constantly with that, so it makes it very easy to play with bigger money and obviously make 100% on your returns. I mean, who wouldn't turn down 100% on $5,000 or $10,000 or $20,000? It's a lot of money that can go involved with that. So use that to your advantage, guys. If there's any questions, feel free to ask me, and I'll be sure to try to answer that. I'll go ahead and open the mic if there's any questions.
Hey, Mike, could you explain the difference between in the money and out of money? I'm still struggling to understand that concept.
Yeah, in the money means that your call option is less than the current price of AMD. So when you see AMD at $53.07, a $53 contract is in the money. The 52.50 is in the money. 52 is in the money. Anything past the current price is out of the money. So 53.50 is out of the money. 54 is out of the money. So obviously these create more value below the current price of the stock, but out of the money, it's a lot cheaper. You're getting a lot cheaper price on it when you're playing the calls here for say. So let's say I want to buy a $55 call at 227. Well, I want to be in the money, so you're going to be paying what, over a dollar more per contract versus being out of the money. And obviously with Tesla, it gets a lot more expensive for sure. I mean, you can pay $100, which is what, $10,000 a contract on some of those. I mean, it gets crazy. So does that make
So
sense?
usually, kind of. I'm just kind of confused, like when to know to buy in the money or out of money. Are you saying you usually should buy every option contract in the money?
No, it doesn't matter. Like if your plan is to hold it to expiration, then obviously you want to be in the money. But since I'm not holding it to expiration, I mostly buy out of the money. So I'm literally betting up. If I'm betting upside on the stock, I'm literally buying outside of the money, and I don't really care to be in the money because I'm literally just playing the value of my bid and ask increasing while the stock goes up and selling
Okay.
it.
Yeah, like you said, buying out of the money is cheaper, and so for my small account, I don't want to actually buy that much of the stock. So just buy something out of the money and then capitalize it before expiration. That would be the smart move, right?
Right. Yep. And make sure you're watching AMD's every move because it's going to dictate the value on your option as well. Even if you hold it to, you're going to lose value with getting closer to expiration. Don't be holding these things for days and days on end when you got an expiration that's within 2 weeks or a week. Because as it gets closer to that date and the stock is not to that options, they start losing value no matter what. Because people don't want to be holding them to the expiration date unless they literally want to have their contract execute, which would buy them literally 100 shares per contract for every for every amount. So if you bought, let's just say wanted to buy AMD, let's say you had one contract, you paid $227 for one contract, $227.50. When it finally came time on March 13th, and you were still holding that contract, the value would probably be a lot less, or it just depends on where the stock is. If the stock is actually if the stock is still at $53 and you're near March 3rd, this would literally probably cost you 10 cents, 5 cents. Like you'd lose all that value if you just kept holding it because it's so dangerous to hold when you're out of the money. It tells people, well, why would you buy a contract out of the money when you're literally got 1 day or 2 days to expiration? Because they lose value. It gives no time for that stock to actually reach that price target. So time decay is a big factor in making sure that you're near the current share price when you place your strike, which these are your strikes. That's your betting price. Does that make sense? I know it's a little confusing, and I know it'll take some time to adjust to it.
Yeah, I mean, I'm just starting to learn about options, so I just gotta take some more time and really research it more. But it's coming slowly but surely.
Good deal. So yeah, just make sure you give yourself 2 weeks of expiration at least. I mean, I'll do it 1 week or so sometimes, but it's risky. So make sure you're giving yourself at least 1 to 2 week or 2 weeks plus, and making sure that your contract is near the current share price before just placing that order, and sell it the same day if you can, or even the next day at the latest, as long as you can judge that AMD is going in your favor till the next day, because these prices can change dramatically overnight. So it's risky holding overnight.
So Mike, using the same scenario, March, at March 20th or whatever, you're buying an option to have 100 shares of that stock at $55 on March 13th or whatever it was. And if AMD is $52 that day and your option expires, then
it expires
buying it
worthless.
for more than what the price of the stock is that day.
Yeah, your option expires worthless. I mean, if you stuck $500 in it, you would have $0.
But if it executes, and say you have the money in there, you're going to get executed at your strike price, which is $55, even though the stock is trading at
it won't. It won't execute at all. It will just expire worthless. They only execute if your option is in the money. But if it's out of the money and it comes to that date to expire, it expires worthless. I mean, it completely deletes itself out of your account.
Gotcha.
And all the money that was involved in that particular play.
Which we're not concerned about, execute. This whole thing's about just trading the option itself at optimum value, bid and ask, and that's it. No execution.
Just capitalizing on the move of the option value, not actually trying to hold the option to actually execute it. I mean, because it is a good deal. Obviously, if I bought $55 calls and the stock shot up to $60 by March 6th, it's giving me 100 shares per contract at $55, even though the stock is trading at $60. I mean, that's a deal, right?
Yeah.
So obviously, if I wanted to do that, then I would do it, but I don't want to do that. I want to make the money on the move of the value of the option, not necessarily hold it to execution.
Yeah, and it's also probably important to note that if you're worried about pattern day trade or PDT, these count the same as trading the stock.
Right. Yep. Yeah, PDT rule takes the same effect. Now, what with cash account, let's say you got a cash account with E-Trade, your funds, as long as you trade the settled funds that day, they become settled again the next day. I mean, there is no 2-day or 3-day settlement rule for cash on options with E-Trade. So it's pretty nice.
Let's say you're buying options with settled cash, and you trade it that day. The very next day, those funds are available to trade again.
Yep. So it's literally like without PDT or anything when you're trading a cash account on E-Trade. It makes it nice. It makes it nice for those trading with a cash account and playing with settled funds. Any other questions, guys?
Mike, for finding the right stocks to start off with options, do you basically look for trend followers? So some that look going up and probably around $50 to $100.
Well, yeah, I generally try to trade those, but like you guys see me, I trade AMD, I trade Tesla, I trade generally almost the same big board stocks every day because you can literally trade them every single day on the options plays. But let's just say big news comes out for a new stock. Like BYD has earnings, okay? Everybody expects great earnings, which their earnings are on the 27th. So I would actually play that stock for the upwards potential for the earnings. The interest of earnings are going to come up. So I would want to play BYD into earnings. So it doesn't necessarily, obviously you don't want to play penny stocks with options. There is some penny stocks with options like FeeSale, and I actually made really good money on that one, but the volume is so low on these particular stocks when it comes to playing options. Okay. You're looking at $2.51 stock. Okay. And to try to play options on that stock it's pretty crucial. It's pretty risky because the options is very, very minimal. See, I'm going to go down here and trade options for it. They've got, 50-cent calls, $3.04 calls, and they're cheap, 33 cents. The risk is very, very huge. Even though the stock is at $2.51, let's say I want to do a $3 call. there's only been 980. That's actually pretty decent from what it used to be, as far as the options contract on it. But just be very mindful of it. Just because you want to trade a $2.50 stock, not every time are you going to find a lot of volume in these contracts. Obviously, if I go to $4.50, there's only 51 contracts that have been bought and sold. Okay, that's very tiny. It adds a lot of risk. You see the bid here at 10 cents and the ask at 15 cents. It's a 50% difference on your entry and exit of the stock in case of downside or upside, per se, and you bought a put or call. It depends if you like the big board stock, and following big board news is very crucial sometimes on these stocks. Let's say that Tesla dropped some great, phenomenal news that morning, then obviously we're all going to play the calls. And I'll look in pre-market, okay? I'll have a scanner up here in pre-market, and I'm going to be looking at the top gainers of the day. Obviously, if you want to look for the top red plays of the day, you can look at some puts, per se, or top gainers of the day. I want to see stocks that are getting upwards action, a lot of activity for the upside in their big board plays. So, like DBX right here, they dropped some news. This is Dropbox. It shows that they dropped a bunch of news here on the 21st, which is Friday. It's up 19%. Calls are going to be getting a lot of interest on DBX. So that would give me an idea for that morning. Well, since that stock's up on pre-market, then options are obviously going to be kind of hot. They're going to get some action. People are excited about the upward move. And as you see Friday, these options went from 116, 60% move, and some of them here in the money actually went really good, almost 200% move in the money. So watching that stock in pre-market probably made some good people some good money had they played that stock in the, just at opening bell. Let me pull it up here. It actually made a big drop compared to its highs there, it looks like. 23 bucks. Yeah, see, that's the big gap up. That was on the 21st. Yeah, that was Friday. See, so it gapped up massively. And a big crucial thing too is most of these gap ups, when they gap up in the morning like that, always wait for a couple time frames before you begin trying to buy an option out the gate. Never buy an option, call, or anything at the opening bell, okay? Wait for the chart to kind of give you a direction of where it's going to go. Obviously, when it comes down here to a bottom, you're like, okay, well, this could be a support area, meaning that's where it opened up at. This could literally be a support area, and sure enough, this is a support area, and this trended up. You could buy a call option right around here, when you felt like it was headed in your direction, in your favor. That small amount of move could have made you 50%, 20%, whatever it would have been on the call option. And I think Guild did it as well. Was another great one that made a great move. It made this whole entire move on Friday. I mean, that's the kind of trends you want to follow. Finding stocks with a technical chart that shows good strength for upwards direction. Yeah, DBX had earnings. Any other questions, guys?
Hey, Mike, Data. Question on the rate of decay. So I know you're swing trading a lot of these options, but with that rate of decay, does it pick up closer to the expiration? And it sounds like it does. How soon do you want to be out of that before the expiration then? When do you really see that rate of decay pick up?
It's generally within the last week.
Okay.
If you play, let's just say like Monday, time decay is going to be your biggest enemy coming Monday for any of these calls. If the stock is not going to go up, or it's going to go down. Obviously, if it goes down, then time decay is going to be more expensive on puts. These are going to go up versus down. But if it goes up, obviously, if DBX continues to go up, the time decay on the puts are going to get cheaper and cheaper and become more and more worthless. I will play some. Let's just say a massive move happened that morning. I have played some expirations where they expired literally the next day. That's super risky, but I was just day trading it. So it had a lot of massive volatility where it was people bought and sold, bought and sold, bought and sold. So the price movement could have been a it's more risky. I wouldn't advise it for new traders.
So that rate of decay, that picks up closer to expiration because there's less interest in the play then?
Yeah, especially the further out you are from the money. If it's near the money, then they kind of hold their value a little bit. But when it starts coming clear to shareholders that there's no way the stock is going to move up that extra dollars within the next day or two or 3 days or whatever, then those options contracts start dropping pretty hard.
And then one other question, because an option's an agreement, not necessarily a sale unless it exercises, do existing options actually have relevance to the movement of the stock?
No.
Okay.
Nope. It's kind of its own. It's kind of its own. It's kind of its own stock, its own level 2, its own trading world, I guess.
Now, when you say a stock gets closer to its stock price, sometimes you'll see more volatility there.
Yeah, there's more volatility at near the current price. Even though you're playing out of the money, these are the ones I really shoot for because they're going to have the most interest, being that they're near the current price of the stock. Obviously, if you traded way out here, you see the interest is only 17 people or 17 contracts that were performed on this exact one. There's 0 on that one. There's only 6 on that one, 2 on that one, 1 on that one, 56 on that one, 1,066 on that one, and 1,008.33. So you want to be playing in ones where the volume is near that current stock price. You see how much more interest it came when it became literally right on top of it there,
Right.
versus playing way out here where you got just next to no volume. I mean, why would it's like playing an OTC stock with 6,000 shares that traded that day. That's it. It's not attractive.
Thanks, Mike. Good answers.
Yep, no problem. Any other questions, guys, before we call it a day? All right, guys, I guess that'll be it. If you guys have any other questions, don't feel free to hesitate. Don't feel free to hesitate and go ahead and chat in the chat room. Be happy to answer you. We do this every single day live. So you literally get to see us play live every single day on our options plays with their live chat. So it's another added bonus that we guys like to trade live. You see our entries, exits, all the calls, the charts. I make sure to call out all the support and resistance to everybody that's playing live with the chat. But anyway, guys, if you got any questions, don't feel free to, feel free to ask. Be happy to help you guys. Anyway,
this will be